is that big existential class where we talk about what the subject means before we actually get into the nuts and bolts. Okay. So what do you guys think? What do you think managerial accounting is about? Internal accounting, that's an excellent description. Other suggestions? Accounting for managers. Accounting or providing information to managers. Managers, employees, people inside the organization. Other ideas. You don't care about the right answer, okay? You'll hear me say this so many times. By the end of the semester, you'll be able to repeat it in your sleep. We don't care about the right answer in class, okay? We do care about the right answer on the test, okay? Okay, the class is where you can work your way to the right answer, sometimes by starting at the wrong point. That's what the class is meant to do. Don't follow the GAAP. Okay, very good. Not related to, not, let's see, not under GAAP. Okay. Any other things that you know about it, any other perspective? As opposed to? Okay. It's broad in its scope across business functions. That's how I'd like to put it down here. This is a very important aspect of the managerial accounting system, and what exactly it means we'll talk about in a few minutes, okay? Okay, so all of these are part of the complete picture of what managerial accounting is. Hopefully, by the end of class today, you guys will have a sort of 10,000 feet up in the air impression of what we're going to do, okay, over the rest of the semester. But here's how I want to start. I would like to start by describing completely what managerial accounting is not about. Okay, and we do that by starting out with something that you guys already know. Everyone's taken financial accounting, so everybody knows what the financial accounting system does. And I already told you the managerial accounting system is complete contrast to the financial accounting system. So we're going to start out by understanding managerial accounting, by comparing it and contrasting it to something that you already are familiar with, which is financial accounting. Okay? Because that's the easiest way to understand something that you don't know, is to relate it to something that you know and to build up from that foundation. So, the financial accounting system I have to remember to write neatly because this is all being videoed. The financial accounting system is also an information system. Let's make sure we know what that means. An information system is just a set of rules on how to produce and deliver some set of information. Okay? What kind of information does the financial accounting system produce? What kind of information? What do you mean by financial information, and how is it different from non-financial information? So we want to make sure that we understand every piece of terminology that we use in class, right? So we use the term, we take it for granted a lot of the time, financial information, we understand what that means. But what exactly is financial information and how is it different from non-financial information? Okay. Okay. So all of that is what? Are you answering the question, what is financial information? Just so that I'm on the same page. Of what examples of financial information, right? Perfect. But at its heart, the thing that this is really something very straightforward. I want to make sure that we're all on the same page here. The thing that distinguishes financial from non-financial information is the unit of value in which the information is expressed. Anything that's translated into money terms is financial information. It's as simple as that. Anything that's not in money terms is non-financial information. Okay? So, if you recall financial accounting, you basically took transactions, bought a piece of furniture for $50, sold something on credit for $100. You took all of those transactions and you translated them into debits and credits. But implicitly, every single transaction you expressed only in terms of its dollar implications. Right? So financial accounting implicitly deals only with financial information, or another way to think about it is it takes all kinds of economic transactions and converts them into the units of value that we understand as dollars. Okay? So if you have a chicken farm and you have 1,000 chickens, okay, that is a piece of what? Financial or non-financial data? It is a piece of non-financial data. If those 1,000 chickens lay 2,400 eggs a week, that is also a piece of non-financial data. But if those 2,400 eggs a week fetch you $12,000 in revenues, that is a piece of financial data. Okay, so now we have the distinction clear in your mind. So the financial accounting system produces entirely financial information, and we heard from, I'm very short-sighted, okay, so you want to make sure that your names are as clear as possible, but you're fine. So it produces information which at the end of any given period, let's say a quarter or a year, describes something to you, and it describes to you all of those debits and credits at the end of the period describe to you the financial performance of a company or a corporation over a particular period of time and its financial position as at the end of that period of time. So two things. Financial performance and financial position. Now, what's the difference between these two? You put your finger right on the heart of the matter. Your financial position is an expression not just of how much debt you have, but really on an accumulated basis how much assets you have, how much liabilities you have, and your assets minus your liabilities that leaves you with what net worth you have in the corporation. So your position is really as of a particular point in time, what does everything that you have done from day one until now add up to? That's what we mean by position, the snapshot. And what is the final product or output or financial statement that describes position? What is the financial statement that tells you about position? The balance sheet. Okay. Now performance is related, it's slightly different. Performance is about what happens in the company between a certain day and a certain day. How much money did we make between the 1st of January and the 31st of December? So performance is between one day and another day in time. So it's a different way of looking at things than position. And what financial statements tell you about performance? The income statement. There's one more. The statement of retained earnings is actually a position statement. Because you think about retained earnings, what the statement of retained earnings tells you is, as of today, how much earnings have you retained in the company from day one over all the years of your company's existence? So it's also a position statement. What is the other performance statement? I heard someone. Because if you start thinking about it in this way, the cash flow statement also tells you what happened between a certain day and a certain day. How much cash came into the company over the 365 days? How much cash went out of the company over that period? Question. Okay. Yes, that's very correct. That's something that we get to in just a few minutes. You're absolutely right. Okay. So financial information that ultimately describes these two aspects or facets of performance. Now, for who? Who cares? Who's the target audience? External parties. Could you be a little more specific? Very good. You guys have done some reading. Okay, so let's talk about investors first. Okay, who are you thinking of when you say investors? People who buy stock, okay? Or stockholders, as they're called. Did you notice I put an arrow? That means there must be other kinds of investors. Huh? Bondholders. Very good. What's the difference? You're correct, but not completely. Okay? So you could buy bonds not just from the government. You could also buy corporate bonds issued by corporations. But the government bond market is far larger than the corporate bond market. So that's one reason why most people believe that bonds are inherently government bonds. You're absolutely just lending them away. So a more general way to describe these types of investments is actually you can have equity investors and you could have debt investors. An equity investor is somebody who invests in the company in return for a fraction of any profits it makes. If it makes zero profits, you get nothing. If it makes a lot of money, you make like a bandit. Okay? A debt investor, on the other hand, is someone who lends money to the company in exchange for what? And what's the key feature of interest? It's fixed. It's agreed at a certain percentage upfront. Regardless of how well or how badly the company does, you're only entitled to that interest. So you understand, payoffs are very different. But equity and debt is similar in the sense that they're both investments in the company. Anyone who's an equity holder or a debt holder has a financial stake in the company's doing well. Okay? So now you will hear these distinctions being referred to by very many different names. So make sure that the terminology does not confuse you. So stockholders are also referred to as shareholders and as equity holders. All means the same thing. People who lend to the company, the simplest way to describe them is lenders. They are also described as creditors. This is a term that you use in financial accounting, actually, creditors, right? Or debt holders. Now, somebody mentioned bonds. We had this discussion about bonds. So, any debt that you take can be in two forms, okay? And we talk about this later, but it's just worth mentioning. It can be in two forms. It can be in the form of a loan, or it can be in the form of bonds, and these are distinct. A loan is what happens when you go to the bank and the bank lends you a single sum of money at a negotiated interest rate. It's a loan. A bond issue is when you go onto the bond market. There is a bond market just like the stock market, and you make a bond offering. So any number of people that are interested in your company will subscribe. So basically, if I subscribe to the Apple bond offering for $1,000, Apple will basically send me a piece of paper that says we owe you $1,000. So a bond issue is where very many people can all lend little amounts of money. Okay, you understand that's the main difference. Okay, but both loans as well as bonds are different forms of debt. So what do these investors use financial statements for? Obviously, to find out if the company is investment worthy or credit worthy, as their objective may be. Now we had talking about the government. Very, very important external user. Okay? Specifically, what branches of the government? Why? For obvious reasons. Want to find out if the company is using the tax code appropriately. Who else? The SEC. Who is? which is, more appropriately, the Securities and Exchange Commission. What does the SEC do, and why are they interested in financial statements? Sorry? Yeah, but what does that mean? Why regulate? What do they regulate? Absolutely, they regulate not only accounting rules but a wide variety of corporate transactions. So, just to give you a little bit of background, the SEC is interested in the financial statements of all public companies. The SEC doesn't care about financial statements of private companies. Now, what is a public company? What is a public company? A public company? That's a different public. Okay, that's a different public. There's actually that's a different perspective on public and private. But there is an SEC definition of what makes a public company, which is any company that what on a stock exchange. That's how we normally think of public companies. But actually, you're right 99% of the time, but that is not the theoretical definition of a public company. A public company is any company that has more than 500 shareholders. So you may be a company that hasn't actually offered its stock on a stock exchange yet, but if you just happen to have more than 500, you become a public company and you come within the SEC's regulations. But you're right, most of the time, companies go public by offering on a stock exchange. Okay? So any company that you can buy and sell off of a stock exchange. I'll give you an interesting example. Google used to give stock options to its employees. It just so happened that one day, they had more than 500 employees that had stock options, and they became inadvertently a public company, and they had to start reporting to the SEC. They didn't like that, but they had to. Okay? So the SEC exists because, think about public companies in the following way. Suppose I have a project, and I raise money from you, the general public. You each give me $100, okay? And I invested in building a canal somewhere. Who owns the canal? You do. Who controls the canal? I do, right? So there's one group of people controlling assets that actually belong to another group of people. And so obviously there's room, there's potential for abuse, there's potential for mismanagement and conflicts of interest and so on. I could just be doing whatever is in my best interest as opposed to whatever is in your best interest. So broadly the mandate of the SEC is to make sure that that relationship functions the way it should. So that's why we have public companies being regulated. Okay? Who else is interested in financial statement information? Competitors, right? Very good. For obvious reasons, want to find out what the company is doing, its strategies, and so on. This is one important reason why you don't get as much information on financial statements as you would like. Often you go through financial statements and you wonder to yourself, it would be really helpful if they broke down this expense into a little bit more detail and told me exactly what they were spending their money on. But you won't get that information primarily because any financial statement is accessible to your competitors also. Okay? And firms don't want to put out what could be proprietary information on their strategy. Good question. Because if you become a public company, any financial state, you have an obligation to produce financial statements and to file them with the SEC. And filing them with the SEC makes them immediately public. And you basically file over the internet. So you could go tomorrow and look up the financial statements of any public company you wanted. Okay? Yes. Actually, you would go to just Google up this. This is Electronic Data Gathering and Retrieval System of the SEC. Every statement that has ever been filed by any public company in the United States is available on this website. Okay, so if you want to do some recreational reading on 5 minutes. Okay, who else? In the spirit of competitors, customers and suppliers also, right? The more obvious one is suppliers. Now, if I were Delphi, and I was supplying auto parts to GM, I obviously want to know if GM is going to be able to pay me back and if our relationship is going to continue. Now, why customers? Now, customers, this is a tricky one. It has to be qualified. Now, it depends on what kind of entity you're talking about. If we're looking at, let's say, Procter and Gamble that makes soaps and shampoos, amongst other things, we're all customers in some way or the other, Procter and Gamble and Unilever, but we don't really care about their financial statements because they produce substitutable goods, right? We could easily go and buy another soap or shampoo. But what if you were a customer of GM or Ford? So you bought a car from them. Why do you have an interest, at least in the short term, in their financial statements? Yes. Why do you want to know? Why are you interested in it lasting? Why in that particular case or not in other cases? Yeah, but why? As a customer? Mm-hmm. Yeah, yeah. Those are intangible things, right? But you actually put it in a nice way because you become a stakeholder in that company, right? And the term stakeholder we use very generally to mean anyone who has a financial stake in that company's future. Now, as a customer, you become someone who has a financial stake in that company's future. Right? Do you have your hand up? Yes, for quality purposes, right? Like if they're having vehicle recalls and so on, and even more, just very, very on a practical basis. It's warranties, service contracts. You want to know if there's going to be a resale market for your car, right? Because that's something that you put into your mind when you're making calculations about your financial future. So the interesting thing about, there could be some other parties that we missed out here. We covered the main ones. The interesting thing about all of these groups of people is that they all function externally. They have an independent life and existence outside of the company. They transact with the company, but they have an independent existence outside the company. So we call them external stakeholders. The stakeholders is generally used to mean anyone who has a stake, who has a financial interest in the company as a result of some past transaction. The financial accounting primarily intended for external stakeholders. Okay? Now, let's make a small grid, which is very helpful to what we're about to do next. We covered most of the points. So the purpose that financial accounting serves is to communicate financial performance and position. So financial accounting is more a communication role, right? So this is the main channel through which the company communicates how it's doing to people outside who are interested in that information. The primary users being external parties. Time focus. This is something that one of the students brought up. Now, in financial accounting, we're describing stuff that already happened in the past, right? So the key thing to recognize is that financial accounting is inherently always backward-looking. It deals with the past. The financial accountant does sort of an accounting historian's job. He takes everything that's happened in the past and he finds a way to describe it in debits and credits. So it's always backward-looking. Any kind of financial accounting that you do. Was there a question? Okay. The level of detail of financial accounting information. Is it very detailed or is it very summarized? This is hard to think about, so let me give you one way to think about it. So what's the top line on the income statement? Huh? What's the top line on the income statement? Yeah, the time period, of course, but then after that. After the year ending. Revenue, the actual statement itself. Yes, the first line is the revenue, right? Oh, you guys are really good. You answered my question exactly. Um, so the revenue, incidentally, revenues are also referred to as top line, Topline, written as one word. Okay? And income is referred to as bottom line. This is sort of colloquial business speak. It's useful for you to know. So revenue. So think about Apple. Reported last year $80 billion in revenue. Okay? So now that obviously did not come from a single transaction, right? It came from billions of transactions, right? It's added up together and made that 80 billion. So every single transaction that happened over the course of the year generated one debit and one credit in the financial accounting system. And at the end of the year, the financial accountants sat and aggregated all the revenues together, all those millions and billions of transactions, and came up with that one line. Similarly for every other line on the income statement and on the balance sheet. So if you look at it that way, you realize that the financial statements are highly, summarized, highly aggregated, right? They tell you in maybe 15 plus 20 plus 20 lines a compact picture of the billions of transactions that the company went through over the course of the year. So when you look at it that way, your financial statements are very much summarized. And then the last thing we want to notice, that we also came up in the course of the discussion, was that financial accounting is highly externally regulated. It's very rule-based. There is a huge external framework of rules and regulations that govern how you account for every single thing. The financial accounting, you don't have a whole lot of room to be creative. Okay? And these rules and regulations are colloquially referred to as, what is this? Generally accepted accounting principles. Who makes GAAP? The SEC is charged with making GAAP, but the SEC has too many other things to do, so it delegates GAAP making to the Financial Accounting Standards Board, or the FASB. Okay? Now, let's get to what we really want to talk about, the managerial accounting system. It exists side by side with the financial accounting system in any organization. Okay? Interacts with financial accounting at many points, but has an independent existence of its own. And it basically fills in the gap that financial accounting doesn't do. You notice we drew a circle and we put stuff outside the circle, so there's got to be something inside the circle as well, right? Who are your internal stakeholders? Who functions inside the corporation? Employees and managers are just a subset of your employees, right? So managers and employees. What the managerial accounting system does is that it produces information that is, interestingly, both financial as well as non-financial. So managerial is much broader in scope than financial accounting, you recognize. Okay? With financial and non-financial information, for what purpose? Well, we've talked a lot about reporting the results that get generated, right? But how do the results get generated? They get generated because managers take a series of decisions every day at different levels in the organization, right? And can decisions be made without information? And that's exactly what managerial accountants do. They produce information that supports decision making. Support decision making within the organization by your internal stakeholders, who are your managers and your employees. So really, financial and managerial fit together like two pieces of a puzzle. Financial accountants take results as a given and report them to everybody outside who's interested. Managerial accountants feed to the decision makers the information that helps them actually take the decisions that eventually translates into the results that the financial accountants report. So fit together like two pieces of a puzzle. Okay? Now, information that supports decision making. I'm thinking to yourself, this is terribly broad, right? Did somebody actually mention the broadness of financial accounting? Now, the description necessarily has to be broad because managerial has a very broad scope. It extends to every function and every level of the organization. Now, you're thinking to yourself, The kinds of decisions that people are going to be making at different levels of the organization are so different. And managerial accounting adapts itself, uses different techniques to support different types of decision making. Think of a very low-level manager in the corporation. Let's say a supervisor on a factory floor. He's a manager, right? Because he has resources at his command that he needs to organize. What kinds of decisions is the factory floor supervisor going to have to make? Just off the top of my head, maybe some machine is not working properly. Should we cancel that assembly line and take it out for repair and maintenance, or should we just continue? We need to produce twice as much as we normally produce because this is a holiday weekend. How do we organize all the factors of production in order to generate that extra production? Those are the kinds of decisions that he's thinking about, right? You think about somebody at a middle management level. So he's probably thinking about next year we have to release 2 new products. What kind of advertising strategy should we design? Should we do in-store promotions? Should we open up a new branch in Newark and so on? Slightly broader decisions, right? Less focused, broader, more impactful decisions. You go all the way up to the CEO. He's likely to be thinking about, well, 5 years from now, what new products should we be bringing to market? If you want to bring out a new product 5 years from now, you need to start doing the R&D right now, right? What new geographical markets should we be expanding into? Should we be getting into Australia or into Asia? You're thinking about decisions that are much less specific, much less focused, range over very long periods of time and impact the entire organization, right? So the kinds of information, the levels of detail of the information that you give, all have to adapt to the kind of decision. But all decisions, no matter who they're made by or where they're made, have some generic characteristics. And this is one of the key things that you learn from the course, really. And that's the decision making is inherently about choosing between alternatives. So I'll repeat that. Decision making is about choosing between alternatives. Suppose you have only one alternative. Is there a decision to be made? No, clearly not, right? So decision making is entirely about choosing between alternatives. So anyone who's making a decision has to first figure out what the alternatives are and make sure that the list is comprehensive. Specify each alternative in a mutually exclusive way, right? And then once you've specified the list of alternatives, then you want to describe each alternative. And every alternative comes with 2 sides. Comes with costs and comes with benefits. And you have to find out, the managerial accountants, that's who I refer to by you, have to find out a way to identify and quantify all the costs and all the benefits. And this is not very straightforward because many costs and benefits can be indirect, qualitative, and difficult to quantify. But you have to find out a way to quantify those. Once you have the costs and benefits of alternative A, B, C, D all specified, then you step back and you find a way to pick the best alternative in terms of the cost-benefit trade-off, right? Which one has the best cost-benefit trade-off? So that's really a generic description of what we'll be doing in many, many different contexts, okay? So decision-making is all about what you do in the future. So really, managerial accounting is entirely forward-looking. So the information that you deal with is really different from what you dealt with in financial. Financial accounting is all about stuff that's already happened. Whereas managerial is about forecasting things that haven't happened yet. Okay, so that gives the information a very different quality. The level of detail at which the information is, you really can't say. It depends on the kind of decision that you're making. Right? If it's a very broad-based, long-term decision, you want very summarized information. If it's a very specific, short-term decision, you want detailed information on the context. And then finally, who regulates managerial accounting? Who specifies the rules for managerial accounting? No, managerial entirely, in its entirety, is forward-looking because decision-making is all about what to do in the future, right? It can't deal with the past. So my question, who regulates managerial accounting? Yes, Eric? So What do you mean by an accounting firm? That's related to financial accounting. Okay? Who regulates managerial accounting? That's right. There is no external regulation of managerial accounting, unlike financial accounting. Financial accounting is very externally regulated, right? Every company has to do what the SEC and the FASB tells them to do. But managerial accounting, there's no external regulation. Why? I mean, because of the nature of the beast, it's for internal use. And each company's internal needs are unique, right? So there's no regulation. Really, the only rules that apply to managerial are the rules of logic, and the rule that really every alternative comes with costs and benefits. And if you're only specifying the costs or only specifying the benefits, that's bad information, right? Any alternative that you pick comes with a trade-off, and you have to recognize both sides. It's really the only